Lithium is one of the hottest commodities on the energy scene, and it's not even a commodity. Primarily used as a base component for batteries, lithium is a high-demand metal that is expected to experience a supply crunch due to a transportation revolution that is fostering a boom in electric vehicles.
Accelerate the transition to sustainable energy. We must produce more EVs. They need to be affordable and a lot more energy storage. So Tera is the new giga. We used to talk in terms of gigawatts. In the future, we'll be talking in terms of terawatt hours.
According to Forbes, by 2025, swelling lithium demand will likely outgrow the supply of all known lithium projects in the world. That's a perfect setup for trading in lithium. But what exactly is lithium? Lithium is a very light, silvery metal, the least dense solid element there is. It's used not only in EV batteries, but also in a lineup of electric devices you use on a daily basis, from smartphones to laptops. Lithium is produced, for the most part, from two different sources: hard rock mining or extraction from brine deposits. Brine deposits are essentially accumulations of groundwater that contain lithium, which is extracted as salt. Hard rock mining, on the other hand, involves extraction from a lithium-bearing mineral called spodumene. It's found all over the world, with the largest reserves in Australia, China, and what is known as the lithium triangle of Chile, Argentina, and Bolivia. The United States has only one functioning lithium mine in Clayton Valley, Nevada. But not all lithium is equal, and this is important. The two primary types of lithium are lithium carbonate and lithium hydroxide, the two types that are largely traded on the markets in one way or another. Each has its own price, which varies from market to market. Lithium hydroxide sells for a premium to lithium carbonate because it is the preferred grade for batteries. It is easy to get confused about the measurements as well. While 1 metric ton of lithium is different from 1 metric ton of lithium hydroxide, both are measured in metric ton of LCE, lithium carbonate equivalent. If you are at all familiar with oil production, you will find something similar in barrels of oil equivalent. And beyond lithium carbonate and lithium hydroxide, there are other specialty lithium compounds that are used for things like Elon Musk's SpaceX rockets. These we aren't as interested in because there's little investment opportunity right now in these specialty compounds. So how do you trade lithium? This is where things get tricky because lithium isn't traded like other commodities such as nickel, copper, or aluminium. No commodity exchange lists lithium. Because there is no futures exchange for lithium, measuring changes in lithium spot prices is very challenging, as is betting on future price changes. While you can invest in lithium by investing in lithium mining companies, either pure play miners or large integrated mining companies, trading it is more complicated. It is not possible to invest directly in lithium as a commodity, and there are no exchange-traded futures for lithium. That means your only options for trading are lithium derivatives or investing in shares of lithium producers. Lithium derivatives can be broken down loosely into two categories: CFDs and options. CFDs are contracts for differences, and they can be a risky game. CFDs are fairly popular trading instruments in general. They allow traders to speculate on the price movements of financial assets, including lithium, without having to own the asset. This is also a popular method for trading in gold, crude oil, forex, and cryptocurrencies. But again, CFDs are risky and complicated. It's important to understand that up to 89% of retail investors lose money when trading CFDs, mostly because they don't have enough experience. Money can be lost at a quick pace because of the leverage involved. The main advantage of buying a lithium CFD is that you can buy it on margin, but the main advantage is also the main risk. You can lose more than 100%, so you have to be prepared. There are some brokers who offer unleveraged CFDs, but then you might as well simply invest in lithium-related stocks or EFTs because the profit potential will be the same. If you go this route, make sure you find a good broker, and they are definitely not all equal. There are specific qualities you should look for before diving into trading a commodity that isn't a commodity using CFDs that you might not be familiar with. First of all, make sure your broker has at least 2 years of experience trading lithium. Then, check you can trace back at least 15 customers who have been using that broker for lithium CFD trades. In other words, Do your homework and make sure your broker is trusted and established. Also, make sure that the broker is in a jurisdiction where he or she is regulated in case of any dispute. It's vital that you understand whether your broker has the ability to get deposits and withdrawals processed within 2 to 3 days maximum. Your broker's delay can cost you a lot of money. If CFDs or options for lithiums are too risky for your appetite, the best way to gain exposure is to invest in companies that are in some way involved in the lithium cycle. Whether it's a pure play lithium miner, a giant integrated miner that mines a number of metals, not just lithium, a refiner, a battery producer, an EV or energy storage company, or an exchange-traded fund that tracks lithium-related stocks in a single basket. If you want to go straight to the top, Albemarle is the largest producer of lithium in the world, the largest supplier of lithium for EV batteries, and it's set to double its capacity in the coming years. Based in Charlotte, North Carolina, Albemarle operates 3 divisions: lithium, bromine specialties, and catalysts. The second big player is SQM out of Chile, with assets in both South America's Lithium Triangle and Western Australia. The former is lithium produced from brine and the latter is from hard rock mining. The company specializes in agricultural fertilizers and specialty chemicals, so you're not just gaining exposure to lithium here. If you want a pure play lithium miner that gains you exposure to lithium and nothing else, then a handful of smaller players fit the bill, including Livent Corporation, Lithium Americas, and Orocobre. Alternatively, you can play lithium from a broader perspective by investing in ETFs tracking lithium baskets. The Global X Lithium and Battery Tech ETF, LIT, invests in the full lithium cycle, from mining and refining the metal through battery production. When to invest in lithium? That's the million-dollar question. We don't have the answer, but we can follow the markets while avoiding the hype. Lithium producers and investors got into a bit of trouble over the past years, jumping the gun on the EV boom and the hoped-for pending supply crunch. It didn't come when everyone thought it would. Still, today, investing in lithium isn't a wild opportunity. It's still early days, and we have learned from the first rush that never happened. These things take time. What is clear, however, is this. The world is undergoing an energy revolution. What we thought was an EV boom before the COVID pandemic was nothing compared to what has become viable since then. There will, in all likelihood, be a lithium supply crunch, which makes for a perfect setup for investors in lithium-related stocks, especially the producers. But patience is the name of this game. This is a long-term bet on the future, not a short-term profit-taking exercise, so choose your play wisely.